But to the heart of your question, I mean, yes, it's the whole issue of housing and property is a big issue on our agenda. There's a lot of discussion in APRA about the risk. There's a lot of discussion at the Council of Financial Regulators with Treasury and the RBA and ASIC about the risks. We've never hidden behind the fact that we are in an environment of heightened risk. Prices are high, household debt is high, interest rates are at historical lows, income growth is low, competitive pressure is strong in the housing market. So everyone needs to be fairly careful about how they operate.
Just a couple more questions, because I do want to go to household debt very briefly, but in respect of the issue of the property market being overheated, particularly in Sydney, I think I'm sitting next to a Tasmanian senator where the median price is, I don't know, 350,000, 400,000. South Australia, about the same bit over that,
yep.
About a third of the median price in Sydney. Do you think there is a case for a regulatory framework or regulatory approach that takes into account the very different property markets around the country? For instance, in various capital cities between Sydney and Adelaide, for instance, Sydney and Hobart, Melbourne and Adelaide and Melbourne and Hobart, and also in country areas where the price of property is much, much less.
So I'll repeat two comments that I made before you arrived, Senator. First is there is, of course, an initiative in the budget to make our power to do that, to have some sense of geographic differential in the way that we apply the prudential framework explicit in the Banking Act. So that power is certainly there, and if we felt the need to use it, to be able to do so. But coming back to what we've tried to do, we have tried very hard to focus on lending standards, and lending standards, good lending standards apply whether house prices are going up, down or sideways.
Take into account geographical considerations.
Well, yes, but house prices in Perth are falling at present. I think that's what all the statistics show. So high LVR lending, one could argue, is just as risky in Perth as it is in Sydney or one of the eastern coast cities at present. So our focus has been good lending standards, banks taking into account conditions and the borrower's circumstances and making sound lending decisions.
Can I just go to the final
yep.
issue? I'm sorry, Senator Gallagher, that's taken a bit longer. The issue of household debt, I asked questions of this of John Fraser, the Secretary of the Treasury, yesterday. Our household debt to GDP ratio, first quarter of 2016, the figures I have in front of me, was the second highest in the world, just behind Switzerland to the second decimal point. And due to a revision in household debt for the second quarter of 2016, our household debt to GDP ratio has fallen to 123%, still incredibly high. Aggregate debt in the private non-financial sector worldwide is 140% of GDP, but in Australia it's at 197%. And that the AMP NatSim survey says that household debt has quadrupled since 1988, rising from 60,000 to 240,000 after inflation. Are these... do you consider that there is a point at which the ratio of household debt to GDP ratio becomes problematic in this country? Because when I asked Mr Fraser that yesterday, he wouldn't be drawn on a figure. Do you have a figure?
He's a wise man then.
Well,
because
I'm not suggesting you're foolish by giving a figure.
So
there must be some point when APRA would be concerned about the household debt to GDP ratio.
We would say it's one of our, higher risk factors at present. So
at what point? Is 200%?
But the issue is that it sort of depends on what else is happening in the system. So it is high, yes, and that is a concern in and of itself. When you put the other things around it, including the fact that income growth is relatively low, so it's a very different thing to have a high level of debt but high income growth, because you can kind of grow your way out of the debt. We don't have that at present, so it's a given level of debt is of higher concern now than it might otherwise be.
So at what point does it become, in your view, does the amber light or even the alarm bells go off? If it's at, say, 123% for household debt to GDP ratio, would you be concerned with 140%?
We already think it's high, and are responding because it's one of the factors
Should it be
that we
lower?
think that leads to concern.
Jump in.
It would be more comfortable if it was lower, yes. Exactly how you achieve that, that's a very good
So when do
question.
the alarm bells go off for you? At 140%, 150%? What level?
I couldn't tell you the figure. It's the combination.
You must
of
have
events
some
that
figure. There must
lead
be
you-
some
that lead
figure
you
that
to
you have.
conclude the metric that we watch most the one that we focus on is the household debt to income level, and
what is it now? What is that level now?
so it's about 170 something percent,
Okay.
180.
So when do the alarm bells go off for you? 200%?
So it ran up. No, I'd say they're going off softly. That's why we've been intervening in the sense that
Could I ask you a